Hi, Peter Rose, Longwood Currency Trading. It's a kind of a brisk late autumn October day in New England, and I'd like to chat with you a little today about the case for making small trading gains instead of large ones. Just a little view of the late fall foliage. I did a video last week and we looked at the leaves on the trees. They were turning and they're beautiful colors. They're beautiful colors today, but we've lost quite a bit of them falling to the ground. And we've had some pretty good windstorms, and the temperature has been going up and then going down at night, so you get those changes and it'll be pretty cool. As you can see from the porch here, it's a little bit different. We've got our wood rack in here, so we're all set for the winter. And what does that mean? Well, we did this work on Saturday. We had a lot of stuff out here. I don't know whether you can remember a scene out here, but we just picked away at it just a little bit. Took a set of chairs out one day, and then went out and took a couple of boxes of stuff that you have out here for summer, and just one little thing at a time over the course of a few days. And this is what we've got left is the wood rack, which we brought in, and a couple of boxes of kindling wood that we'll go through pretty quickly, and that's it. And everything else in here, the rug and everything else, has been taken out. So we accomplished a tremendous amount by just doing a little bit every day. And that's sort of the thrust of my premise, that we should be trading for small gains instead of trading for big gains. The reason for this video is I was thinking about this. I've been discussing with some friends of mine this constant debate between, do you do short-term trading, or do you do longer term, off the longer term charts, the daily chart, so you're making maybe 3 or 4 trades a month, or a trade a week, or whatever, to get your 100 pip targets or 50, 60 pip targets? Or do you do it like me, short-term day trading, some scalping, 2, 3 pips is great, and if things are going against me, well, I just get out. So I get a couple of pips there and a couple of pips there, and it adds up. I was reminded of the process of golf. Now, I'm not a golfer, but I grew up with my dad being a golf nut, and a lot of my friends over the years have been involved in golf, so I know a little bit about it. I played a little bit, but I just can't see chasing a little white ball around an open field. But the premise of golf is you get a 4 par, and you don't try to do it in 1. Well, if you're a real hyper pro, you could try to do it in 2. But most of us just would go out there and, knock the ball where we're comfortable, where our skill level is, or where we know the terrain, or the wind is just right now, and so we're going to take that little shot. So you sacrifice maybe 1 or 2 swings in order to get the ball down the field and into the hole, or you take these wild, huge swings at it, and maybe the thing plants itself in the woods, or you drop it in the brook, or whatever it is that you do, where the thing just goes completely crazy. Trading is the same way. You can trade for 100 or 200 pips. You have to be patient, and you have to wait. And how do you know that the retracement at any given time is not going to be a swing? How do you know that? You don't know that until it gets to wherever your stop is. Well, if you're shooting for 200 pips, let's say, which if you're playing off the daily trade, if you're not shooting for 200 pips, you're wasting your fucking time. You don't know what you're doing. But if your target is 200 pips away, then your risk is 100. It could be 200 pips if a 1-to-1 risk to reward. Is that 25 or 35 pip retracement? Is that a retracement and it's going to turn around, or is it going to keep going and hit your 50 stop? or your 100 stop. It's that's a tough call to make. I mean, I think you have to have a lot of confidence in your ability. You have to have a lot of long-term trading in order to look at a weekly or a daily chart and say, well, yeah, 2 weeks from now there isn't going to be any war, nobody's going to get killed, the economies are going to be fine, the number of COVID cases isn't going to exponentially increase all of a sudden, the whole restaurant industry isn't going to collapse in 4 days like it did, a few months ago. We're in 2020, October 2020. If you feel comfortable with that, and you feel comfortable with exposing yourself to a 100 pip loss, then that's great. And the argument for that is that the patterns are more dependable at those higher time frames. And I would tend to agree with that, except I don't believe in patterns. I believe in repeating indications of trading campaigns by the large institutional traders, but I don't think you can say, oh, we're forming head and shoulders here because that might not have anything to do with what that particular trader is doing. He's not going into the process of executing his customer orders by saying, gee, I'm going to create a head and shoulders pattern here so all these dumb fucking retail traders, I'll catch them at the end. No, he didn't care about the retail traders. He cares about getting the best prices for his customer. Sometimes that'll result in what's called railroad tie pattern, a pin bar, which is just a railroad tie pattern on a higher time frame, and shoulders or flags or all that other kind of crap. But if you are in a trend, and if you're a long-term trader, you have to be trading on trends. How do you know whether that trend is going to continue? It's very problematic from a short-term trader's standpoint, my standpoint. The case for making short-term trades, being happy to pick up 5, 8, 6, 3, 10 pips, even though you might be shooting for 25 or 30 or 40. And again, this is based on the currency pair that I have and what the ATR is and all that other kind of stuff. But you can take the principles that I'm talking about and extrapolate that into long-term trading. You can't take the principles of long-term trading and extrapolate them down into short-term trading. It doesn't work. It doesn't work the reverse. The fact that I have control over my risk in a short-term trade, where I don't really feel that I have control over my risk in a long-term trade. I don't know. I don't know whether that retracement is going to go on and hit my 100 pip stop. Why would I sit there and let it go at 100 pips? Why wouldn't I get out early? Well, if you're going to get out early, then don't shoot for the higher profit target. Take a smaller profit target. I mean, everything is relative to what you're trying to do. What do you say? Oh, I've got a 200 pip profit target and I'm going to have a 12 pip stop. Well, there's no rationale for that, because the reason you're looking at a 200 pip profit target is because of structural components or momentum or whatever the heck it is that you're doing. But that can work in reverse against you. It can take that price down into retracements. How far do you think that price is going to retrace? And multiple time retracements perhaps between today and 200 or 300 pips from here, which is going to be 2 weeks from now. Now, it could be tomorrow. I mean, currency pair that I trade, for example, has a current ATR of about 85 pips, 85 to 100 pips. But it's easy to go to 120 pips, and a lot of the major pairs will do 120 pips. So you could make your hit in 2 days if the thing goes straight up with the momentum. But you know what? They just mess around. Look at your charts. They didn't go up 120 pips a day. It has a 120 pip range, but it may only end up 30 pips for the day, or 20 pips for the day. Or it could end up down 80 pips. So if you're going to wait until the end of the day and go, oh shit, this thing closed 80 pips down, I got a 100 pip stop, I'll just get out now. You're not trading under best principles guidelines for for the methodology that you've chosen to trade, and you've violated the principle of having a stop that's far, that's 100 pips away, by getting out early. You got to figure out what your rules are, what you want to do. I don't want to have to worry about any of that stuff. So the case for taking short-term gains is that I can absolutely control my risk. It's a short stop. If I enter the trade and it goes against me, I was wrong. What am I going to do? I'm going to wait until it goes up 20 or 30 or 40 pips and it starts to turn around and come back, and I go, well, I'll just wait until it goes 30 pips down and then my next 12 pips or 8 pips or whatever it is and takes me out. No, you're going to get out right then. The only thing we have control of is our risk. We don't know how far the price is going to go up. We can take a probabilistic view of the momentum of that price at any given time and say it has a higher likelihood that it's going to go 25 pips before it has any kind of a retracement. And if it does begin to retrace, it's probably going to retrace 20 pips, 15 pips. So if I can grab 5 or 10 pips on the way up, and I have a float stop that's 5 or 8 pips behind the price, it goes up a little bit more, and then it starts heading down, and it takes me out after another 8 pips. I've already made 10, and then I've got another 6 or 8 on the way. I've made 15 pips for the day on that trade. Well, look, that's 1.5% per on your risk. If you have a $1,000 account, you make 15 pips, you make $15. $15 is 1.5% of $1,000. So you're making $15 $1,000. You have a $100,000 account. Do the math. I mean, what are you expecting to get out of your trade? You expect to go in and hit that 200 pip thing, and then the next day you're going to take a 100 pip loss, and the day after that you're going to take a 100 pip loss, and now you're at jump ball. You better have better than a 1 in 4 win to loss ratio, or you're cooked, baby. You really are. Or you got to have a tighter risk to reward. And if you have a tighter risk to reward, why not trade down on the smaller time frames where your probability of getting 5 or 10 pips is far greater than your probability, particularly as an intermediate or beginning trader, of getting 100 pips. When I first started trading, I took a course from one of the best traders in the country. And his thing was, he was always shooting for 100 pips or whatever, and his stops were 50, 60 pips all the time. And I'm trading with a $1,000 account, a mini account, trying to get started. I think a 50 pip hit. Well, Jesus, that's a 5% hit against my bank, a 5% per thousand. Man, I just, as a beginner, you're only winning 1 in 4, maybe 1 in 5, until you get your experience down. Well, by the time you get your experience down, you're out of fucking money. Oh man, I just did a blog post on this fallacy of the 2% reduction in your lot size as you lose. You might be interested in that. Go to Longwood Currency Trading Blogs and take a look at the 1020 post that I have on that, because you're out of money sooner than you think you are because of the margin. That's the whole thrust of the thing. So I'm happier, only worried about my trading, if worried is a good term, because I'm not worried about it. It's like watching a TV show. I'm not worried about the TV show. I'm enjoying it because it's only an hour, and then I go do what I want to do. So if I'm going to trade, I get up, I look at the screen, and if it doesn't look like there's going to be a trade, then I'll write somebody a letter, or I'll work on a computer programming project, or I'll read a book, or pick my nose. I don't know what I'm going to do, but I'm not going to sit there and fucking create a trade. If there is a trade to be made, I'll say, look, I can make a 0.5% on this just in a heartbeat. Might be able to make 1%, but I can make a 0.5% just because of the way that I understand volatility and how things set up and all that kind of stuff. Well, look, if you make a 0.5% a day and you trade 4 days a week, that's 2% a week, 8% a month. I mean, that's a lot. Okay, can you expect to do that? Well, probably not. I say when I trade, I try to make 0.5%. And over the long run, you try to make more than 0.5% a month, but you certainly don't have the expectation that you're going to make 8% a month either. That would be nice. I mean, that's 80% a year in your trading, and you can do that if you have $1,000 or $3,000 or $4,000 account. You probably make 60-80%. But once you get up trading a $100,000 account or $50,000 account, well, now if you're not well balanced emotionally, those bigger losses begin to affect your mental capabilities and your psychology, and you tend then to cut your winners short and let your losers run. And that's what happens. So unless you have a really sound trading process and methodology for controlling your risk, you're screwed when you go up in bank size. So all I'm saying is that I'm never going to change my process, because I don't trade for the money, I trade for pips. I'm trying to make 5 pips a day. That's it, 5 pips. Everybody out there saying, oh, you need 20 pips a day, you need 10 pips. You don't need 20 pips a day. You know how tough it is to get 20 pips a day? We got to do the longer term trading anyway to start with. And if you're a beginner, you're going to have a tough time doing that. There's a high statistical likelihood that you're going to lose 6 trades in a row at some point, say within 100 trades. If you have a kind of a intermediate level win-to-loss ratio, or you're doing risk-reward in a certain way. See, it's a very high probability you're going to take 6 losses in a row. So look, boys and girls, you take 6 50-pip losses. If you're trading a full lot, that's a lot. If you're trading a 10 lot, that's a lot of money to lose, right? So you have to balance your expectation of what you're trying to make. I did a video the other day on don't trade for $1 million. Don't trade to be a millionaire. Don't be a pig. Pigs get slaughtered. That's what they say in the stock market lore. So there's my case for trading for the smaller gains as opposed to the larger gains. I've only said this about, this is my 51st or 52nd video. So I've probably only said it in about 40 other videos and 20 blog posts, but that's okay, because that's the way it is. We do not have any control over how much money we're going to make. The only thing we have control over is how much we'll lose. And it's your choice. You can float that stop, or you can set it fixed pip. I just heard a video the other day from a professional trader, is very well respected. I love his stuff, and he's calling us that set fixed pip stops impractical and dangerous. Well, I beg to differ with him. And if you can pull it off, that's fine. I'm much calmer sitting down at my computer. Yep, there looks like a trade here. Oh, I lost my 8 pips. All right, I'll go have lunch. Or if the thing turns around and goes in my favor, I'll take the trade again. And if the thing originally goes in my favor and I lock in that 5 pips, I'm happy with that. If it turns around and goes against me, I've zeroed out my risk. If it continues to go and hits my second stop target, I'll peel another lot off and I'll float my stop. And I'm always trading from that standpoint in risk-free. I did another video and also a blog post on changing my attitude toward staging out lots. I think there's a lot to be said for that, particularly in how I've restructured how I'm doing my trading. Well, I'm not going to get into all that because that video isn't about that. I'm not trying to teach you what I do. I'm just trying to alert you to some thoughts that you need to go through as you build your trading plan. You figure out what you're comfortable with, consider that trade-off between trading for the smaller gains, the shorter gains, as opposed to trading for the long run. I mean, the longer term time frame, not the long run. You're always trading for the long run, because in the long run, we're all dead. In the long run, if we do the right thing, we'll be rich. So I'd rather be dead and rich than dead and poor. That's kind of morose, isn't it? It was kind of a takeoff on Janis Joplin's "I've been rich and I've been poor, but I like rich better." I think accumulating the money is safer, taking the shorter term gains and working your way down the golf course fairway in short hops, and ensuring yourself you're going to get to the hole without going into the water. That's all I'm saying. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. Let me open the door and get a last view of probably one of the last days we're going to have these beautiful leaves up.